I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, talks resume. High-level negotiations between Washington and Beijing begin again this week. We dig into the issue of intellectual property and U.S. companies that do business in China. Plus, another privacy alert. If you use Amazon's Cloud Cam, someone may be watching your video footage. Details from a Bloomberg scoop. And user base bump. Roku stock surges after an analyst predicts the connected TV company will triple its user base by 2022. We hear from that analyst, Tim Nolan of Macquarie. But first, to our top story. The U.S. and China are hoping to ease hostilities in their 18-month-long trade war. They began 2 days of negotiations in Washington today. The White House is considering a partial deal that would include suspending planned tariffs. To discuss, Bloomberg's Josh Wingrove joins me now. Josh, what do we know about what could evolve from the latest talks?
Well, just now, President Trump spoke to reporters on the South Lawn of the White House. He's on his way to Minneapolis for a rally. And if you'll forgive me, I'll just read from what he said. He said they just completed their day's negotiations. He said they're going very well. He later said really well and very, very well. That's pretty much the detail that we have from him. But, you know, that's better, I guess, than the alternative of him coming out and saying that they're not going well. We have a meeting scheduled tomorrow at the White House with the president and the Chinese vice premier. That all eyes will be on that one. In particular, we have zero details right now in terms of subject matter that they might have made progress on or did not make progress on. You know, whether they're still looking for sort of a more of a bite-sized deal or whether they're still talking towards the broad, comprehensive deal that the president wants. But at least for now, the president is giving sort of positive signs.
Josh, it has been 18 months. At this point, is a partial deal better than no deal?
Yeah, I mean, yeah, I think any deal is better than no deal. I think markets would react very negatively to a no deal situation. I was a bit triggered seeing video of them going into USTR from covering NAFTA, which took, you know, about the same amount of time. And there were efforts there to what they call it harvesting, which is taking all the stuff we've agreed on, putting that in a bow and, you know, moving on, at least for now. But Trump has been resistant to that in the past. He signaled publicly that while he would consider pretty much anything, that his preference is a big deal. The problem is that will take time. Those things always take more time than you think. But, you know, they thought they were near a deal earlier this year. Whether they can get back there or not is the open question.
Josh, we frequently get tweets from the president, and one stuck out to me today when he tweeted that China wants a deal, but do I? What does he mean by that?
Guessing what he means is I guess, my job now these days. But I think he demands deals to be on his terms, or at least seen on his terms. I think trading partners have learned to more or less shrug that off. So he wants to be invited to the table rather than inviting people to the table. And so I wouldn't put a lot of weight in that. What he's been saying consistently for weeks is that, you know, he thinks China wants to make a deal. He thinks China is being hurt more by the tariffs than U.S. consumers are. Of course, U.S. consumers are paying the tariffs that he's applying. So he thinks that the U.S. can wait this out longer, and therefore he thinks that China will want a deal more than the U.S., and that if the deal is good enough, then he'll sign it. But otherwise, he's called himself tariff man. He's good with the tariffs as they stand.
And we sort of get, Josh, these small potato headlines that come across. Any sense of why we're getting resolution on perhaps smaller deals, China buying more soybeans, but not some of the bigger issues, namely IP theft, for example?
Yeah, it's a great question. Or forced technology transfers. These are things that Peter Navarro and White House officials have been talking about a lot until about a few weeks ago, and now they're not really getting into specifics. If we do get that interim deal, you mentioned agriculture. Trump wants that as an election issue. He wants to be able to tell farmers in swing states that the Chinese are buying a lot of their crops. But I think the White House does honestly still believe that the core issue here are things like IP theft, are things like forced technology transfer. There's bipartisan support to go after China on these things. So even if they do get a small deal, I think those issues will remain core to a larger deal going forward.
Bloomberg's Josh Wingrove, thank you for joining me. All things trade. And securing IP protection is among the main points of those trade talks, as the counterfeit goods market is still a problem in China. And if you are part of a U.S. company that wants to protect its intellectual property, you might turn to my next guest. It's Eric Geiler. It's a CEO of a Chinese subsidiary, Ciprin Global, and he joins me from Boston. Eric, first, I have to ask, what does Ciprin do?
So Ciprin and Ciprin Global, Ciprin is a fairly large company in China, 1,600 people, just sub $100 million in revenue, that files and protects intellectual property for clients previously have mostly been in China and is now starting to expand into the U.S. And that's what we're doing here at Ciprin Global, based out of Boston.
Well, and Eric, as we, in this segment right before you were talking a lot about the trade talks that are going on. What kind of IP theft language do you need to see to get a deal?
Well, sort of regardless of the status of the trade talks, the importance of securing IP protection for U.S. companies that are operating in China should not get lost anywhere. And so it's U.S. companies just shouldn't be missing out on that opportunity if they're going to operate in the Chinese market. And by the way, since most things, or many things, are manufactured in China, they are in that market already.
Who's stealing whose IP?
Good question. So there's a fair amount of confusion when it comes to what are we talking about when we talk about IP theft. It really needs to be defined a bit better. We hear that routinely, and the question is, what are we talking about specifically? And we don't hear a lot of specific examples that are at all recent. I think most people, though, tend to think of IP theft as being counterfeit goods, and that's a very real problem. It exists here, it exists in China, and it's a problem for any manufacturer that's outside of China. Where we tend to be thinking about IP is in the patent world, where you're actually disclosing, when you get a patent, is getting that patent protection not just in the United States, but doing it in China, where China is fairly open to protecting their markets for anyone operating inside China by filing and protecting it with patents.
Eric, do you trust, though, those protections in Beijing, given the relationship between the U.S. and China aren't the best right now?
Well, so if we just abstract ourselves from the battle and just sort of put that aside for a moment, when you get a patent in the United States, you're telling the world how to practice your invention. In exchange for the rights to do that, you have the right to exclude others. But you only have the right to exclude others in the United States, and you've made your invention public. And anyone from anywhere in the world can look at the United States, look at your patent, see how to practice it, and then go ahead and do it. And if you're not protecting it in the country where someone's doing it, you don't have any protection. And so it's largely a situation where you want to file for protection in China, if you're going to be filing for protection at all. It's almost crazy not to be doing that if you're going to be operating anywhere in the world besides the United States.
What companies do you work with are you concerned about most?
So we work a lot with companies that span run the gamut from technology and life sciences companies, and our customers actually are U.S. law firms. So when we got into business, there are 4 people here in Boston, as I said, 1,600 in China, and we're not trying to recreate the distribution mechanism that exists for IP protection in the United States. And in the U.S., that's done through IP law firms. So our customers are those firms, and what we're trying to do is make it quick, efficient, and for any U.S.-based inventor to get that protection in China, and working with the law firms.
You know, Eric, I chuckled a little bit in a recent article that you did. You mentioned that it wasn't the Chinese that were stealing your IP, it was a Canadian. Outside of the conversation about China, what are some of the other hotspots where you see IP theft?
So there is a fair amount where things are manufactured. So and yes, I was joking about the Canadians. That was many, many years ago when I was an inventor at another company, and we sued a Canadian company for patent infringement. And that actually is a very interesting issue that exists in China right now. If you're a plaintiff, a foreign plaintiff, and you sue for patent infringement in China, you'll win over 90% of the time. If you ask a U.S. patent attorney, what's your chance of winning in the United States, regardless of the status of your case, I think the best guess you'll get from any U.S.-based patent attorney is it's 50-50. It's largely a crapshoot. In China, the odds are in your favor that you're going to win.
Very interesting. Finally, give me a sense of the attorney fees that go on if there is theft of your IP or a patent infringement, as you said.
So what's interesting about the Chinese patent and IP market is that, generally speaking, it's done by agency. It's not done by law firms, and the cost factors are considerably lower. So if I were trying to put it in perspective, I don't know that it's an order of magnitude different in price, but it's probably on the order of, it'll cost you on the order of 20 to 30% of what it would cost you to protect your IP in the United States. And there's no reason not to do it. I think that's the really simple message, regardless of the status of the trade between the two countries.
I learned much about patents today. Thank you. That was Eric Geiler, the CEO of the Chinese subsidiary Ciprin Global. And coming up, the Internal Revenue Service comes out with its new rules on cryptocurrency, and at least one accountant says his clients are worried. We'll run down the new rules. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. A slew of new tax rules for cryptocurrency investors. The Internal Revenue Service came out with new guidelines on Wednesday. We're exploring what they mean. With more, it's tax attorney Dashiell Shapiro with the firm Chartis Freeze. So first, tell me sort of what we know about this new guidance.
Well, Taylor, the IRS is playing catch up here. The last time they issued guidance was in 2014, and since then the cryptocurrency market has turned into a $200 billion market. So investors have been demanding greater clarity and guidelines on how to report their cryptocurrency transactions. So the IRS is responding to this demand, but doing so several years too late, according to many.
Well, and interesting to note, you said that they're sort of taking a page out of the Swiss bank's playbook, which probably is cost effective. What do we know about the Swiss bank playbook that we're sort of copying, if you will?
Yeah, so the IRS pulled in billions of dollars going after Americans with Swiss bank accounts, and they did it without doing a lot of work. They didn't audit very many people, they didn't prosecute many people, but they got everybody to come forward by scaring them and gathering data from all the Swiss banks. Everybody had thought the Swiss banks were impenetrable. Nobody will ever know if I have a Swiss bank account, and now all those books are open. And the same thing is hopefully going to happen with cryptocurrency in the IRS's view.
One of the complicated issues around cryptos is you have Bitcoin and then Bitcoin Cash. How are both of those treated on a tax reform?
Yeah, so the new guidance says if you own Bitcoin and then magically in your account tomorrow you have Bitcoin Cash, that may be a moment where you have new taxable income. But it's sort of a fun puzzle as a tax attorney because it gets at the basic question of what is income. If someone throws gold coins into your backyard, do you have income? Maybe if they deposit it in your bank account, but if you don't know about it or if you don't take steps to use your new Bitcoin Cash, do you really have taxable income? And so that's what this new guidance is trying to address and help people navigate.
How do the crypto exchanges respond to this?
Well, the crypto exchanges are pretty much waiting for guidance from the IRS, and the IRS is in turn waiting for guidance from Congress. The IRS has pretty much said it's not their position to tell crypto exchanges what to do. Right now, if you have a trade on a crypto exchange, you don't get a 1099-B like you would if you sold shares of Microsoft. But it seems like Congress could step in and give clear rules to say crypto exchanges should report these trades just like stockbrokers, and then it would make tax reporting a lot easier.
And is that what you think we need as the next step, given the exchanges and the IRS are sort of playing chicken and egg scenario?
That's one thing that could help, because right now what IRS is doing is they are having to go issue enforcement against exchanges to pull records. IRS had to sue Coinbase to get their records, and it would be easier if we had some simplified system where exchanges could self-report.
You know, you started out this conversation saying it's a few years late. I wonder, better late than never?
Definitely better late than never, but there's a lot of ground to cover, and the IRS just sent out letters to 10,000 cryptocurrency investors warning them that they have to pay their taxes. It's one thing to warn investors, but it's another to not give them clear guidance on how to report their taxes, and so that's where the confusion steps in.
Okay, well, trying to help explain some of the confusion is Dashiell Shapiro from the law firm Chartier Friess. And coming up, we will hear from Bob Greifeld. He's the former Nasdaq CEO, his experience turning Nasdaq into a powerhouse for tech IPOs. This is Bloomberg. Here's a look at today's top tech calls. Shares of Netflix fell Thursday after UBS cut the price target from $370 from $420. Goldman Sachs also cut the price target to $360 from $420. UBS analyst Eric Sheridan said investors have grown fearful that Netflix will again miss subscriber estimates this quarter. The company reports third quarter results October 16. Shares of Roku were upgraded by RBC analyst Mark Mahaney back down to an outperform. This is after he downgraded the stock on July 1st. Mahaney stated that he sees the valuation as more compelling following a 31% pullback in the stock. He also views the company's fundamentals as among the strongest in the small cap internet sector. And Peloton was rated a new neutral at MKM Partners, which initiated coverage of the stock with a price target of 24. Shares closed Thursday at around 23. This is the third company to initiate coverage of the stock after the lockup period. So far, one buy, one hold on the stock. Now, when Bob Greifeld took the reins at the Nasdaq in 2003, he knew he had his work cut out for him, as did the board. The former fintech executive got off to a running start. He made key personnel changes, trimmed costs, and made some big deals. In the process, he made Nasdaq into a very different institution. On Thursday, Greifeld spoke to Bloomberg's David Weston about his new book, Market Mover: Lessons from a Decade of Change at Nasdaq.
The most important move we made is to buy INET, because we got the best technology on the street. And a lot of the high-frequency firms use some version of INET today. So we gained market share in INET. When I think about the 47 acquisitions we did, the only one that we had to do, independent of price, was INET, because we were at institutional risk. We were losing market share every day, we were losing money every day, and we didn't have in-house any technology on the shelf that had been proven, that I had great faith in. So that one we had to do. The rest of the acquisitions were optional, and we were really using that to take strength and build upon further strength.
So you took NASDAQ and your stock price was going on nicely, and then 2008 happened.
Yeah, that was
it put some stress on everybody, including you, to be able to, on the systems basically, to clear all the trades that were coming through. But then there were reforms afterwards, and in your book you recount a situation where Jamie Dimon, the head of JP Morgan, called you up in not altogether a friendly way.
Well, there's some four-letter words there, but I would say this. One, our systems worked well through the great credit crisis. We were hitting volumes we only saw in the lab, so that was nerve-wracking. We bent, but we didn't break. Then we had the lobbying for what the future should be, and it was a professional, disagreement in terms of how things would play out. One thing I would have to say with Jamie, we lived through some difficult times with Facebook, and to his credit, he gave me a call during some of our darkest post-Facebook days and said, Bob, you'll get through it, it'll work out, and I appreciate that.
Well, talk about that Facebook problem, because it was pretty well known, and it's treated in the book fairly directly.
Yes.
Where I think probably I would say as a non-engineer, your engineers sort of got ahead of you.
Yeah, I see it's a really big loop. So I came there, and we had a certain culture. We changed it, and we made the engineers really the king of the ship, and the organization was not balanced. So I did my self-reflection. I said it was my issue because I created a culture where the engineers could overdevelop systems without any check from the people running the businesses. So we had to basically evolve. We learned from it. We became a more balanced organization and a better organization.
So, Bob, right now there's a big dispute, contest, discussion going on about IPOs, which were terribly important to you at Nasdaq, as opposed to direct listings. But Nasdaq, as I understand it, sort of had both experiences. Didn't you start out with a direct listing before you got there?
We did it when I was there, actually.
Oh, when you were there?
Yeah, we were.
So what's the pluses and minuses of direct listing versus IPO?
Well, I think the direct listing will have a niche. It's not going to go away, but it's not going to take over the market, right? So if you have zero need for capital, you have a brand in the investment community, then direct listing comes into frame and you have to make your decision. The advantage of the direct listing then is you don't have to get involved with what is the right price, right? So if I'm a company, I come public, the stock is up 40% or down 40%, I'm the CEO of the board. I don't really want to be in that game of trying to decide how to play that. I'd rather just get the right price. So if you list first and then raise capital a year later, right, then you'll know the price because the stock is trading. So that's an attractive alternative to some, but not to many, I would say.
But if you look at tech, which certainly you specialize in at Nasdaq, we've had several of these IPOs go out, and certainly the investment bankers or the management didn't find the right price.
That's happened.
They've been
right?
very disappointing the last few weeks.
I would say. I would also say this, though, that the public markets will discover the right price with a lot higher frequency than the private market. So when you look at the source of some of this issue, you had, I think, abnormal price discovery happening in the private market. The private market is primarily a bilateral deal between you and I, right? We could get it wrong, right? Public market, you have all to all, a lot of people in it, and the odds of getting the price right are significantly higher.
That was former Nasdaq CEO Bob Greifeld speaking with Bloomberg's David Weston. And coming up, Bloomberg Scoop, what Amazon could be doing with your cloud cam home security footage next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Now to a Bloomberg scoop. Just months after learning an Amazon team was transcribing and annotating commands recorded in customers' homes by the company's Alexa digital assistant, another privacy issue has emerged. If you use Amazon's Cloud Cam, Bloomberg has learned the online giant may be watching some of your video footage. Here to explain is Bloomberg's Matt Day, who covers Amazon in Seattle. Talk to me about what the bigger story is here. Is it the privacy concerns or the fact that, frankly, Amazon's admitting a little bit that the Cloud Cam can't do it all? It actually needs humans.
I think it's definitely the latter part, is that, basically anything that these companies market as artificial intelligence, it probably has a human playing some role. And now it might not be a very large role. I mean, Amazon told us in the case of Cloud Cam that humans only look at clips if you either submit them for troubleshooting, say something didn't work or a notification was wrong, something like that, or in cases of employee trials, so folks who presumably had a sense that there might be some kind of manual review of their clips. And so as far as we know, that's a small percentage of sort of the total volume of video out there, but still an indication that Amazon thinks that they can't do this sort of with algorithms alone, that they need humans to help improve their software.
Right, and I mean, so when it comes down to some of the privacy issues, like you said, Amazon saying, well, it's only when a customer submits it for troubleshooting. Is that enough transparency?
I'm not sure. And Amazon, like a lot of companies, does not go out of its way in kind of the privacy policies in terms of service and sort of the FAQs they post on this stuff for consumers to read, to really walk them through, hey, listen, this is what we're doing to make your experience better, make our product or service better. And a lot of that just goes on kind of behind the scenes. And after these companies get from you these kind of big blanket permissions to use your information and your data to improve their service, they don't take the next step to kind of handhold you and say, this is what we're going to be doing with it. And I think that's what caught a lot of people off guard with the revelations earlier this year that there were humans behind a lot of the voice assistants companies are marketing, is that consumers just didn't take that step with them and had no idea.
It's interesting. You went through the terms of service, and you note in your great article that they do nothing to say that there are or could be human review of these videos. At what point do these companies start to become more transparent and say in their terms of service, there's a potential for human review of this?
Well, I think they've already started that, but it's baby steps. Voice assistants got a lot of attention earlier this year, and Amazon in particular has now disclosed, or now discloses rather, on their websites and on the information about their Alexa service, that humans do review a small sample of sort of the total voice volume, and they give you the option to opt out. And so I think as kind of the disconnect between what sort of the man or woman on the street knows about these programs and what the tech companies assume they know, as that kind of becomes public, companies are taking these sort of baby steps to explain and be more upfront about what they're doing, but there's still, as this story proves, a little bit of a way to go on that.
Bloomberg Technologies' Matt Day, thank you for joining me. Now, Roku had its best day in about 2 months on Wednesday. This was after Macquarie Research upgraded the stock. It was the first such move by an analyst since a sharp recent decline in the shares of the video streaming platform. To discuss the move, I bring in Tim Nolan of Macquarie. And Tim, you did move the market on that call. So talk to me about why you're so bullish on Roku, given sort of the heightened competition in this space.
Sure, there's plenty of competition, and we highlight that pretty thoroughly, I think, in our note. The stock had come down from 175 or so to about 100, so that was kind of an opportune moment for us. But essentially, it's partly the international expansion that we talk about in our report. We think Roku going from almost zero to some large number internationally, and we think they can get to approximately their size internationally that they are in the U.S. now within about 3 years. On top of that, connected TV advertising, which I think is really the growth story here for Roku, is absolutely growing very, very strongly, and Roku has built itself a great position to continue growing into that.
So let me parse down a few of the points that you hit on, one of which was the stock falling from a 170 to 99 in a matter of 2 to 3 weeks, as you mentioned. How much of this was purely from a multiple standpoint? It looked relatively cheap.
Well, at 170 or whatever, you could certainly argue it got quite expensive. You had a number of software-related type of stocks trade down. A number of its kind of broad peers traded down quite heavily as well. So I think it was as much sector rotation going on at the time as anything. But look, the stock went from, 55, I think, was its more recent low, up to 170 within the space of whatever, 3, 4, 5 months. I mean, that's just such a sharp move. I think anytime you get that quick a move, it's just not surprising to have it come back and take a breath. It came down quite sharply. There was some increased news of competition. We heard about Amazon Fire TV. We heard about Comcast with a Flex product, which I don't really think is a competitive issue for it. But more competition coming at the time. It's just kind of the wrong combination of factors for the stock.
You mentioned earlier about international expansion being key, sort of as a catalyst for the stock going forward. What types of numbers on that international side do you need to see from the company to maintain your thesis?
Well, the thing is, we don't really know anything about the international expansion, and we don't know anything about the strategy. We know 1 or 2 bits and pieces about markets and devices, but we don't know the rollout schedule. What we've done in our report is tried to lay out what we think is a reasonable assumption based on connected TV penetration rates into homes where Roku can get. So that's where we get to our estimate of them getting into about 35 or so million households internationally within 3 years' time. So that's on the device side. Another way to look at it is on the advertising side. And again, this is really the more important story for them, is the advertising platform. And if you look at connected TV advertising growth, I mean, it's growing double the rate or triple the rate now from a year ago. If you even put a more modest assumption of growth onto that and layer that over a few years' time, you get to pretty similar numbers that we come to for Roku's growth in terms of revenues over the next 3 years.
And is that advertising the way Roku stands to differentiate itself from the competition that you highlight in your report, saying, quote, it's real? I'm thinking Facebook, which has a hardware product, Comcast, which came out with a similar competing device.
I'm thinking of the competition more in terms of on the device side with someone like an Amazon Fire TV that I think is getting more aggressive now with their device rollout. And there's a very interesting divergence here in strategies between Roku and Amazon. Roku is, we think of them as something of a walled garden in terms of protecting some of the data that they gather, and they've got so much great data on consumer viewing habits. And that's quite different from what Amazon has just begun doing in the last month or two, which is opening up its ad platform to some of the demand side platforms to buy more openly ads on its Amazon Fire TV. So very different strategy from these two different companies. It'll be very interesting to see how it evolves. I don't necessarily know if one way wins in the end or not, but Roku for right now has a really nice mousetrap, a lot of users. I think international expansion and CTV ad growth, just as I said, you know, doubling, tripling in size this year, going to flow onto that platform.
Tim Nolan of Macquarie, thank you so much for joining me. And coming up, we'll check in with Delivery Hero CEO Nicholas Ostenberg about how his company can become the largest global food company. This is Bloomberg Technology. Samsung's responding to supply and price pressure from fast-moving Chinese rivals. The South Korean conglomerate will spend $11 billion developing and building next-generation displays. That's one of 3 areas in which Samsung is the world leader. The others are memory chips and smartphones. Food delivery remains a tough market. Front-runners Uber Eats and the UK's Deliveroo remain unprofitable. And we continue to see consolidation with established giants Takeaway.com and Just Eat preparing to merge. Delivery Hero is a key European player. They sold their German business to Takeaway.com earlier this year and are now seeing customer growth in new markets across Asia and the Americas. Bloomberg sat down exclusively with the CEO of Delivery Hero to discuss the competitive space.
We are winning market shares in every region against every competitor globally. We are on path to be the largest food platform by the end of the year. And if you take the example of Germany, at the time we did less than 500,000 orders in a country like Taiwan. Now, 8 months later, we do 7.2 million orders per month in Taiwan. That's 3 times the many orders we did in Germany back then. So we see that the investments that we have been doing with the proceeds of that transaction are really paying off.
So you see more of a future in emerging markets. I mean, you've got out of a couple of developed markets, recently. You mentioned Germany, and there have been others. Will you be selling more developed market businesses to focus in on the emerging market space?
So we're generally focused on markets where we see the best return, where we see the highest frequency of customers, where we see the best return on every single incremental order. And that's we have in Middle East and Asia and Latin America. But also in some European markets, some Eastern European markets, see very good returns. So right now I think we have a very good footprint where we have no general interest of selling in the markets, but I'll doubling down in those that we are active in.
Okay, so doubling down on the markets you're active in, and what you're trying to do in some of those markets is deliver more stuff. So not just the food, but to be a little bit more, dare I say it, like an Amazon. Are you not concerned that the margins in that kind of deliver everything business are a little bit on the low side?
So our main focus is to deliver what customers really want and then work back for us from there, finding ways to actually making it happen. And that's why we look at groceries, pharmaceuticals, we look at payments. And if you take an example of this will be Turkey, and we start delivering from our own warehouses where we can deliver in 13 minutes. That's way beyond what Amazon can do. And we now work from there to actually improve the economics. We have reached a point where we can actually deliver things on good economics. And we see that in particularly in this quarter how overall our business now, logistics efficiencies, are improving profitability per order. And that's very encouraging.
As you look into the future then, Nicholas, what percentage of your business do you see being in food delivery and what in other logistics provision?
So I still think that food and hot food is our main vertical, and that's where we have our core. And I do believe that is still probably 90% of our business. But from time to time, you need something, and we want to be there for our customers. We want to be that platform.
Why be in something else, though, if it's just 10% of the business?
We still want to make sure that our best customers can go and stay on our platform when they need something. And also having them to continuously come back to our platform gives value. And of course, if you at that time can deliver your toothpaste that evening, then you really need it, you will build a strong love for our brand. But then on the other 9 occasions, you might order food and get that delivered. But you will remember that experience.
My teeth will be grateful, I'm sure. What dictates what makes a successful market for you then? Is it a culture of food ordering, or is it a lack of traffic on the roads? I mean, what differentiates the really profitable markets from the less so?
So we look at customers and how frequently come back, and also the margins we can get on incremental orders. And what we see in those markets is it can drive very good profit contribution per order. And as you get scale, like we have in the Middle East now, we start turning very good profits. Or Europe, we have reached that break-even point. So it's just about scale. So once you get the economics, things looks very good.
That was Bloomberg's Anna Edwards speaking exclusively with Delivery Hero CEO Nicholas Ostberg. Meanwhile, earlier on Thursday, Bloomberg's Francine Lacqua sat down with Randy Zuckerberg, founder and chief executive officer at Zuckerberg Media. The two discussed the changing media landscape, the need for consolidation, and the evolving role for females in the industry. Take a listen.
100 million hours of video gets uploaded just to YouTube, and that's one channel in one day. Every day there's over 1 billion posts on Facebook. So you're right, who is out there listening to your content if everyone else is just constantly making their own content?
So is it going to go down? Is it going to be oversaturated? I don't, in 5-10 years, what kind of content are we going to be looking at?
I think there's almost going to be a layer of kind of curation, like in museums. I think with so much content over there, it's just exhaustion. And so people are now looking for experts to tell them what to watch. I think the pendulum's almost shifting back again to the bigger need for expert voices in news, in different areas, because people are now bombarded by so much that they kind of want to be guided a little, like you would curate a collection at a museum. But I also think that people are they want more high quality content again. So it's interesting because when I was first starting in social media, it was all about how many eyeballs you could get on things, and now I think the metrics are really shifting back to kind of engagement and depth.
But are the next 3 years going to be critical on who survives and who gets it and who doesn't?
Absolutely. It's going to be very critical, and companies are going to have to make sure that they're playing in all of the new spaces. That's why we're talking about audio so much at Zuckerberg Media, because I think that is one of the only spaces at the moment where there are more people listening to podcasts than there are podcasts that are regularly updated. There was a brief window around blogging like this about 20 years ago. That window is gone. I would not suggest to anyone today to launch a new blog. The world doesn't need it. It's impossible to get noticed. But podcasting and audio is still in that really beautiful window right now. And so I think the media companies that are nimble enough to see those opportunities and get in will survive.
As we look at the 2020 presidential election in the States, how should media companies look at this election differently?
It's interesting because it's so fragmented. I mean, you see there's so many candidates, there's so many people that are thinking, that have passions around different issues and different topics. I think, it's gone are the days when you had a few sources that were the go-to places to turn for an election. So I think media companies, they have to almost think of themselves as 20 or 30 tiny little media companies, or arm their employees to be individual media companies in order to be reaching the most people that they can. But it's an excitingly creative and stressful time to be working inside a media company, for sure.
And Randy, you've done so much work on gender diversity and female in the workplace. What's tougher, being a woman in charge in tech or a woman in charge in Hollywood Broadway?
Oh gosh, wow, that's really the question of the time. I used to joke that being in Silicon Valley, that my biggest asset was having a man's name, Randy, because I would email people and they wouldn't know that they were emailing with a woman, so I was able to really get ahead. I think things are definitely changing for the better. There's a lot more discussion stemming at least from the Me Too movement, and I am at least seeing now in Silicon Valley the rise of many more female investors. I think once women start to control more of the money, then they are going to use that to turn around and invest in other women and change the system a little. So that's what I'm interested in, but there's still quite a long way to go, especially, I sit here talking to you, I'm just 3 months after having a baby, and I've been back at work for quite a while, and then I sit in a city like Helsinki hearing about 9 months of maternity leave and things, and I realize we have quite a long way to go still in the world.
That was Randy Zuckerberg, the founder and CEO of Zuckerberg Media, speaking with Bloomberg's Francine Lacqua. And still ahead, Apple CEO Tim Cook defends the company's decision to yank a police tracking app from the App Store amid pro-democracy protests. We'll get the latest from China next. This is Bloomberg. Apple has reversed course on Hong Kong. The company has pulled the plug on an app that showed police activity in the city. Apple says it could endanger both police and people who live there. CEO Tim Cook came out Thursday to defend that decision, saying the app was being used maliciously. With more, I want to bring in Bloomberg's Selena Wang, who joins me from Beijing. Selena, what is the significance of Apple now pulling this app from the App Store?
So this is a crowdsourcing mapping app that allows users to see where protests and police activity is happening. And you have an instance here where Apple is reversing course yet again after saying it spoke to local authorities that said it was threatening public and police safety. Now, the app creators have said there is no evidence of this, and critics have scorched the company for saying that it is basically capitulating to China's demands at the expense of free speech. But to be clear, this isn't the first time Apple has made moves like this. A few years ago, it removed VPN apps from the App Store in China. More recently, it removed the Taiwan flag emoji app. I mean, Greater China is Apple's largest market after the United States, so there is a lot at stake here for the company, and it just underscores the increasing challenges when it comes to balancing political risks both at home and abroad for international companies operating in China.
And within that balance that you talk about, was this really harming police, or is this seen really as caving to Beijing?
We did hear from the Hong Kong legislator say that he was deeply disappointed in this decision, and that, in his view, this is actually hurting individual passerbys, innocent passerbys, who would use this app to avoid violence. Again, the app creators are saying that there is no evidence of this being used to threaten public safety, but Apple said it did speak with local police and authorities and did an investigation showing that it was used to potentially target individual police and individuals in areas where police aren't around. I think the broader significance of this also points to what we've seen happen to other companies that have gotten caught in the fray, not just Apple. You've seen companies from Vans to Starbucks to Zara to Activision Blizzard have to toe this delicate line and really get scorched when it comes to taking a side on either side when it comes to the Hong Kong protests. I think the NBA is a really relevant example here. I mean, a single tweet has threatened the entire business of a company that in China has spent decades building their business there, and they have more than 800 million fans. And with the single tweet seeming to be sympathetic to the Hong Kong protests, you have firms from Tencent to C-Trip, the state broadcaster refusing to broadcast their games anymore, all distancing themselves and cutting ties to this company. We have seen Beijing take a very hard-line, zero-tolerance policy approach when it comes to companies seeming to meddle meddle in what they say are internal affairs.
Selena, I wonder, as we see companies like Apple, you mentioned the NBA, seen as caving to pressure from Beijing, what does that do about relationships with Hong Kong?
Well, we know that right now it's a very, very tense environment, and China has taken, again, a very hardline approach, saying that this is an internal affair. They don't want to see Western companies meddling in what they say is their own territorial sovereignty. Now, the tech decoupling is only escalating, and the difficulties of Western businesses doing China is only escalating. Recently, we did also see Chinese companies put on a U.S. blacklist. We heard China hit back very hard against that blacklist, saying to stay tuned for retaliation, and that China could be coming out with its own unreliable entities list that could include U.S. companies on it. And the companies that were on China's blacklist, on the U.S. blacklist, are considered national champions in China. You have SenseTime, the world's most valuable artificial intelligence company, as well as Megvii, that counts Ant Financial, Foxconn, and Lenovo as its clients. So the tense situation is only escalating.
Bloomberg's Selena Wang in Beijing, thank you for joining me with the latest. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.